Financing working capital, factoring. So in this session, we'll go through factoring basics. We will see what factoring is and we will go through the basics in factoring. So before factoring is explained, we should know what are account receivables. As we know, a manufacturing concern gets raw materials from suppliers and then they manufacture goods or services, finished goods or services, which get sold to customers. So if the customers buy these finished goods from manufacturers on credit, the account becomes account receivables. That is, manufacturing concern should get goods from customers. So these are what becomes account receivables. So factoring facilitates collection of receivables, account receivables, as well as provides resources to finance account receivables. That is what factoring does. So the main function of factors is realization of credit sales. So fundamentally, the main function of factoring is realization of credit sales. Once it has gone real, the factoring services works between the buyer and the seller and also sometimes with the seller's bank to realize the credit sales. Now, other functions of factoring includes maintenance or administration of credit sales and of sales ledger, financing trade debts or trade facility, collection facility of account receivable, and assumptions of credit risk, credit control, and credit restriction. We will go through each of these items in the later session, but before that, we have to also understand that factoring services emerged in India in the 1997. In existence were two sponsored organizations, SBI Factors and Commercial Services Limited and Can Bank Factors Limited. So these were the two organizations, sponsored organizations, which were in existence in the year 1997. Now we'll take a look at what are the functions of factors. The first function is administration of sales ledger. Client sales ledger are maintained by the factor. Factor also maintains invoices. Let's see what are invoices. So upon completion of a sales transaction or a sales deal, an invoice is sent by the client, which is the seller, to a customer, and a copy of the sales invoice is sent to the factor. Under open item method, generally the ledger is maintained where each receipt is matched against a particular invoice. So each ledger item or receipt is always matched against a particular invoice. The customer account is reflective. Customer account to the factor would mean it is the buyer's account. It's reflective of various open invoices outstanding on a given day. The factor also gives periodic reports to its clients. Clients of factor means sellers. So the factor gives periodic reports to its clients or seller on the receivables, on the account receivables and the current status of the receivables. In order to identify the payment pattern, the factor also maintains a customer-wide record of payments spread over a period of time. So customer account has open invoices on a given day. It also maintains a customer-wise record of payments spread over a period of time. Also, along with the periodic report sent to its client, the factor also sends current status of the receivables, receipt of payments from the customers, and any other useful information concerning the credit sales to its clients or sellers of the factor. Periodic reports which are sent to client has current status of receivables, receipt of payments from customers, useful information concerning credit sales to clients or sellers of the factor, which is already told. Now, next one is financing trade debts. Factor may purchase book debts of its clients or seller at a price, and debts gets reassigned to factors, who also goes ahead with granting advances to the extent of 80% of assigned debts. Now, factoring debt with recourse. What does that mean? Whenever the debts are factored with recourse, the finance becomes refundable by its clients. If the buyer makes a default or non-payment and without recourse, the factor is forced to collect the dues from the seller on due date, no matter whether the buyer makes the payment or not. So this completes financing trade debts. Next one is collection facility of account receivables. Collection of account receivables is considered the most important function of factor. It undertakes to collect receivables on behalf of its clients so that clients may concentrate on its own business rather than waste effort, time, and manpower on the collection activity. Whenever there is a legal action instituted against the customer of a factor or buyer for non-payment, factors consult with the respective client or seller in case of non-payment by the customers of the factor. So here the major function of factor is collection of account receivables, and customer client consultation is done by the factor whenever there is a legal action instituted against the customer of a factor for non-payment. Customer of a factor is always buyer. Next one is assumption of credit risk, credit control, and credit restrictions. Let's see what it is. It is periodic report sending to clients. Let us just elaborate a little bit on that. A factor without doubt assumes credit risk as its own function. This service is provided for debts that are factored without recourse. For approved customers, factor in consultation with the client fixes credit limit for approved customers or buyers. Once the limits are fixed, the factor undertakes to purchase a customer's trade debts without recourse. That is to say, the factor assumes customer's risk of default in payment. From this particular aspect of the factor, the client gains immensely in terms of 1. Factor relieves the client from collection work, and 2. Factor advises the client on the credit worthiness of the customers. To think about it from an operational standpoint, the line of credit limits up to which a client can sell to customer depends upon the following few factors, namely the customer's financial position, the value of goods sold by the client to the customer, as well as on the customer's past payment record. Most of the factors provide periodic reports to clients on customer credit utilization, and this is done before any major sales is made in any regard. These periodic reports are made out after getting an assessment on reports such as credit reports, bank reports, trade references, financial statement analysis made from current ratio, quick ratio, return on investments, and net profit margin. So this completes assumptions of credit risk, credit control, and credit restrictions. So this completes also financing working capital factoring. Thank you.